My name is Roland Schuster. I'm the managing principal of the Schuster Group and president and founder of TANGO. Business doesn't have to be a win-lose proposition. That if you structure your organization appropriately, you can really create a lot of goodwill, yet make money too. And that's what we've done at the Schuster Group. And TANGO is now a platform where a lot of businesses that share that philosophy have joined. And really, when it's all said and done, it's kind of a partnership between for-profits and nonprofits working together for the mutual benefit. Next slide, please, Amber. So all of our partners share this philosophy, and we hand select them. We turn down, quite frankly, more than we accept. But these are all the folks that sit on our TANGO platform. They are all experts at working in the nonprofit sector, and they really genuinely have a philosophy of supporting the sector to the point that they pay to be part of TANGO so that the nonprofit sector does not have to. So all of you guys that are members of TANGO, thank you for joining us. It's free because of the generosity and the philosophical commitment of all of these for-profit firms that are part of TANGO. I just want to lastly kind of close by just stressing our mission. It's really threefold. First of all, primarily we try to make nonprofits better from a business perspective. That's really embedded in all of our partner DNA. We're business people, and we are trying to share our intellectual capital and our knowledge with the sector for free. And we do that through education and training. This seminar or workshop is along those lines. And I'd like to give a shout out to Rob Bloomstone, our director of marketing. He does a great job organizing these. Thank you, Rob. We're on track to run probably 60 formal presentations this year. So it's a lot of work behind the scenes to get to where we are. But Rob, thanks for all your efforts. Secondly, we try to save nonprofits money. And we do that through a preferred services platform. Things ranging from employee benefit plans to insurance to accounting, IT, legal, marketing services. There's a lot of resources in the family of TANGO that if you're looking to potentially save some dollars, especially in the post-COVID world, I encourage you to take a peek at our partner grouping. Every one of them has a special value proposition that is unique to the TANGO membership, all geared to save nonprofits money. And then lastly, mission support. We are aligned very closely with the nonprofit sector in a way that we're trying to do things beyond just business. So we have a foundation that provides scholarships to rising stars within the nonprofit sector. If you have somebody in your ranks that you feel is deserving of some additional training or education, we encourage you to apply for our scholarships. It's right on our website. We also have something called Donation Depot, which is a matchmaking service for high-end used office equipment. So again, it's our way to give back to the sector through what we do every day in our businesses. So without any further ado, I'd like to turn the presentation over to our speakers. And just one last comment. If anyone does have questions on the capabilities of TANGO or would like to have a quick discussion with any of us on our leadership team about the resources embedded in the TANGO platform, please reach out to us. We're happy to do so. But today we're going to talk about the Paycheck Protection Program, PPP, as we all know it. It's being presented by Amber Tucker, CPA, Director, Assurance and Advisory Services at FML, and Bill Claffey, Partner, Tax Services, also at FML. So without any further ado, if you two would like to take it away and enlighten our audience as to what's happening with PPP, that would be great.
Great. Thank you so much for the introduction. And thank you for all that have joined us so far. I have muted your line as you joined, but I may have missed one or two of you, but I think I got you all as Roland was giving us our introduction to TANGO. So I am Amber Tucker with FML, and I'll allow Bill to introduce himself. But just to introduce the firm, we are headquartered in Glastonbury, Connecticut. We're about an 80-person firm with offices also in Enfield, New Haven, and Stamford. We specialize in many of industries, one of which is nonprofits, which is why obviously we are partners with TANGO, and we're happy to be a part of the group. It is a special group, and I found a lot of help, and my nonprofits have enjoyed becoming members as well. As PPP was being put together and COVID and the pandemic was beginning, our firm quickly jumped on board and created a task force. So there's 6 of us that meet at least twice a week, Monday and Friday, to go over the updates. As you're well aware, the PPP and the guidance from SBA and others is changing rapidly. It has slowed down obviously a little bit, but changes are still occurring. And we are still waiting for more clarification guidance as well. So I am going to let Bill introduce himself now. Go ahead, Bill.
Great. Thanks, Amber. My name is Bill Claffey. I'm a partner at FML, working with Amber on a number of her clients. I'm on the tax side of things, focusing on state and local credits and incentives, lately PPP, and other kind of special projects. I'm actually an attorney by degree, kind of accountant by trade. So when we put together the task force, my role on it, coming with my background, coming in from that angle, made sense. And so we at FML have tried to stay on top of these things, not only PPP related, but there's been other programs, right? The Family First Coronavirus Act and EIDL loans and other IRS updates, state tax updates. So we've tried to stay on top of that. For purposes of this presentation, we've done a number of these webinars as we've gone through the PPP process, but this is really focused on the PPP flexibility and how that changes the PPP program as we knew it for several months, which has been both good in that it does provide some flexibility, but a little bit frustrating as well, I'm sure, to a number of folks that may be in this audience that have already kind of gone through and maybe at the tail end of their old covered period. So we'll jump right into that. We'll start talking. We'll go through that. We'll try to go through examples. Amber, if you have questions you want to throw out there, feel free, and we'll kind of keep it in kind of a dialogue format. Otherwise, I'm just going to kind of go through these slides. So if we look at the PPP program, as you all know, that was enacted on March 27th through the CARES Act. A lot of guidance has come out over the months, and then word on this Paycheck Protection Flexibility Act came out about a month ago. There were kind of whispers as to what it may or may not be doing, but it was passed. It was signed into law on June 5th, and I've listed it there. We're going to go through all these things in some detail, but there are 6 shifts in PPP policy as you might have it. The first relating to the covered period extension, that's the 24-week. And I'm sure folks that have been following this or have loans have heard that 24-week period extension. Also, there's some provisions on the minimum payroll spend. Again, if you've been following this, you've heard about the 75%, 25%. So there's been a shift there. There's been a shift in the safe harbor dates, and we'll talk about that. The Flexibility Act introduces some brand new safe harbors, which were not part of the CARES Act and may be relevant to a lot of folks on this call. May not, but it might be relevant. The payoff deferment is extended, and then there's a deferment of employer payroll taxes that was part of the CARES Act and kind of has gone through a couple different iterations. We'll talk about where that sits right now. One thing that we'll say here on the bottom, and we gave a very similar presentation about a week ago to a different audience, but everything we talk about today is going to require you to go back through your facts and your circumstances and do your own analysis as to whether the 8-week or the 24-week period makes sense. Like I said, it all sounds good that folks have an extended period of time, 24 weeks to spend the money here, but you really need to examine your facts. You need to have a really firm handle on your full-time employees, both your numerator and your denominator. If you're not familiar with that concept, that's what drives your loan forgiveness reduction. And also your spend, right? Making sure you're spending on the eligible expenses. We can go forward there, Amber.
Yes. So as we go, I didn't mention in the beginning, there's no Q&A section, but if you have any questions, feel free to put them into the chat box, and we can interject your questions as we cover the information.
So the first point here, the Flexibility Act extends the covered period to 24 weeks or December 31st, whichever is earlier, right? For most folks, and I've worked with a lot of clients. I've probably spoken to over 200 companies about PPP, both for-profit, nonprofit, big, small, I guess they're all small under the SBA, but loan sizes of anywhere from 30 to 40,000 to 5 million. So a $5 million loan I don't view as small. And they've all started at different points. Some got in very early, and they're literally at the end of their 8-week period, and some got in kind of the second tranche there, and so they're somewhere in the middle of their 8-week period. But in either case, the Flexibility Act has extended the covered period to 24 weeks. So if you have, and so that the enactment date of this statute was June 5th. If you receive a PPP loan after June 5th, your covered period is going to be 24 weeks. If you received your loan before June 5th, then you have the option, and that's the second bullet there, to use an 8-week covered period. Now, why would anyone do that? Why would anyone choose to use an 8-week covered period versus a 24-week covered period? Well, there's a number of reasons. One is you may be at week 7 or week 8 and you've already spent the money anyway. And so you'd like to just apply for your forgiveness and get in early in the queue and hopefully get a decision earlier. Or, and we are awaiting guidance on this, is it's not clear whether if you elect the 24-week period, it seems like it's an either 8 weeks or 24 weeks. It doesn't seem like you can elect go for the 24-week period, but then apply for forgiveness in 10 weeks or 11 weeks. So it's one or the other. And if you do choose the 24 weeks, you may have a requirement to keep your employee equivalents during that 24-week period. And that could be a challenge for some businesses. So just be understanding of your fact pattern there as you there we go. As you go through that you may be in a situation where you've spent 90% of the loan proceeds, maybe 95%, and you can squeak out another 10,000, 15,000. But if you project out and you don't think you can keep your full-time employee levels at whatever number you were at, 20, let's say, and because of what's going on, you may have a reduction. You may want to run the numbers on that and see, is it a better result to spend the additional $10,000 to $15,000, but have an FTE count that may reduce the loan forgiveness, by more than the variable if you just chose the 8-week period. So again, analyze your facts. This question has come up, and I've done a lot of kind of research just trying to find what other folks are saying about this, but the 15,385, that's always been the number. The 15,385 has always been the number that was capped at, right? So if you had an employee that made over $100,000 during your 8-week period, they may have, their gross pay may have been $17,000, $20,000. For purposes of the loan forgiveness, that amount was getting capped at 15,385, which was kind of a prorated amount. Well, now you've got the 24-week period. Does that amount go up to 46,155? I don't know what the answer to that is. If any of the folks here listened to our webinar, I think it was last week, we kind of went back and forth on that question, kind of a little bit around in circles. And we basically had told the audience, listen, the SBA likes to issue guidance on Friday nights. So stay tuned and we'll be back in touch with that answer. Well, they did issue guidance on Friday night, but it had nothing to do with any of the questions that anyone wanted to hear about. So unfortunately, we don't have an answer to that question. So, as that comes out, we'll clearly make everyone aware that in this audience and the rest of our client base, but that's an unanswered question. Saying those salary reduction commitments, that's kind of the same as the FTE that I said, kind of beware of. If you choose the 24 weeks and you need to reduce salaries, you may have to watch that, because if you choose the 24 weeks, you may have to keep those salaries at a certain threshold through that period. Okay, I think we've gone through the points there on that slide, Amber. Okay, so we got the 24 weeks. Second big point here is, so they extended these safe harbor dates. So in the pre-Flexibility Act world, folks that had a PPP loan that had a reduction in their full-time employee counts, right? So as you know, you go through your loan, you spend, I'll just use some easy numbers here, you spend $100,000 and you've got an FTE count of your numerator being 9 and your denominator being 10, right? So that's 90%. That loan would have been 90,000 of that loan would have been forgiven based on your FTE count. However, there was always the safe harbor that said if you get your employee by June 30th, if you get your employee counts up to the level they were on February 15th, then disregard the FTE reduction calculation. Oh, I mean, I've had some clients that were starting to not manage toward that, but it was the reality of their business. And so they were planning on bringing some folks that they had to furlough or lay off, bring them back by June 30th, so that the FTE count wouldn't be severely reduced. Well, the Flexibility Act basically takes the June 30th date and eliminates it. That date doesn't exist for PPP anymore. And it pushes it out to December 31st, 2020. Well, what does that mean, right? So now if you've got a PPP loan and you may be at week 7, you may be at week 8, you may be at week 6, and you were planning on, and you had this reduction in FTE count, or you had a reduction in salary because the same kind of safe harbor concept existed. You've got to wait till December 31st to get your employees back to February 15th numbers in order to take advantage of the safe harbor as it stands right now in the Flexibility Act. That's, to me, and I think Frank Milone, one of my other partners, said it on a webinar we did last week. That seems illogical, but then a lot of this seems illogical. We can only apply what's in the statute and what's in the guidance, and unfortunately, and then what's in the applications. There's also frequently asked questions that are not regulatory or statutory law, but they give you a little bit of insight as to where the SBA may be going with certain things. But that's the way it stands. So if you were planning on using the safe harbor of June 30th, now you're gonna have to wait till December 31st. And if you do, and just practically, if you do need the safe harbor in order to kind of cure your FTE issue, right, which would be a smaller numerator than the denominator, you're not going to be able to apply for forgiveness until at least January 1st of 2021. Amber, I don't know if you want to make a comment on that with regard to, I know you got some slides coming up on the, June 30th and revenue recognition. That's right. Going to put a big crimp in the plans.
It is. It becomes a big issue for those nonprofits that are on the line that have a June 30 year end of the issue of when am I going to be able to recognize this income, the debt forgiveness, that I've had these expenditures for. So essentially you're going to have all these expenditures from the time you receive the loan through June 30th, but it's unclear if I can match that revenue. So we'll definitely get into that conversation more when those slides occur. But I just want to reiterate, Bill, so if I choose to use my 8-week election, I need to then use whatever my average FTEs or my FTE calculation at the end of that 8 week. I won't be able to use a safe harbor, or if I want to use that 8 weeks, I would have to wait until December to actually apply?
Yeah, I mean, as it stands right now, and again, I was really hoping that, Saturday morning I'd wake up and have something nice to read. And unfortunately there was an interim rule in there, but it didn't have the meat that I was hoping that it would have. But as it stands, yes, you may be in a position where you would say, I'm going to choose the 8-week period, because I've already spent the money. And that's a fairly common fact pattern, especially when again, for those of you that, I apologize for kind of keep going back and forth, but for those of you that may not have either heard any of our prior webinars or just kind of getting into the PPP program now, when the SBA issued the application for forgiveness, they clarified the cash and the accrual concept, and so now you've got this kind of both concepts going on. But what it did is that really opened up the time frame. So even though your covered period was 8-week period, you could really kind of sneak 9 weeks, maybe even 10 weeks out of that through the cash and the accrual concept, and the ability to use this alternative covered period, which they also introduced in the forgiveness application, which is going to have to now be revised, by the way, because of the Flexibility Act. But a lot of companies were already through, because of that, because of those two concepts, they were already able to spend 100% of their loan, a lot of it on payroll only, but certainly payroll, and then you include rent and utilities. So they already know they definitely don't need 24 weeks, and they don't even need really 9 or 10 or even 11 weeks. And so they're going to make this 8-week election, but they may have had a drop in full-time equivalent employees, and so they're going to have to wait for 6 months, regardless of that. They know they're going 8 weeks, right? They don't even have the money to spend to go 24 weeks. So they know they really only have 8 weeks in there. And they don't want to have to have the FTE commitment for another 16 weeks when there's really not, there's either no money, no additional PPP funds to spend, or there's very little when you it's de minimis relative to the rest of the loan.
Right.
Hey,
And it is,
and I can get it. Go ahead.
I can answer a couple of these questions right off, or group a couple of them together. If we finish our spend down, right, and I think you've said this, so if I finish my spend down on the 9th week or the 18th week, there's no clear path yet of when we can apply for the forgiveness. We do know we have 10 months to apply, but we don't know how soon we're able to apply yet. Is that correct?
Correct. Well, one is that the revised application hasn't been published. Now, I say that, and then I was on an email chain. Actually, Amber, I might have been on your email chain, where a bank had forwarded to a client something related to the revised forgiveness application. If they do have that, I don't know where they got it, because I couldn't find it. It's not on the SBA, the governmental websites. So I'm not sure if any of you folks are getting information from your banks or applications from your banks on the revised, forgiveness application related to the Flexibility Act. It'd be great. Please share with us if you can, but I haven't seen it. I don't know. And so I imagine that the SBA is going, and there's also additional, we're going to get into this. There's, you've got safe harbor dates. You've got additional safe harbors. They have to revise the application. So since to my knowledge, that's not published yet, folks can't apply. I imagine once that does get published, and I do have a number of clients that want to get this thing, they want to apply as soon as possible.
Right.
I imagine there's going to be some dates in there. That application will say, will have some sort of time frame that the minimum that you can apply, right? Whether that be 2 weeks after your covered period or your elected covered period, up to 10 months, which is what you had mentioned, Amber.
Right. And just one more question before we move forward. When do we calculate the FTEs? Is it at the 8-week period and at the 24-week period and then at December 31st? Can you clarify that?
Sure. So right now you've got your denominator, right? And you're in that quotient calculation that's going to get applied for the FTE reduction, right? And that denominator is the 2 periods, right? So those that aren't familiar, you've got two options in your denominator. One is February 15th to June 30th of 2019, do an FTE count on that. The second option is January 1st to February 29th of 2020. So that becomes, you have one of those two options you can choose. That's your denominator. Now your numerator is your FTE covered period. And that's kind of, and this goes kind of back to what I was saying in one of the earlier slides, is that your FTEs in the numerator is your covered period. So right now, if you choose the 8-week option, 8-week covered period, your FTE count would be, starting on the date of your disbursement, or if you choose the alternative covered period, that date, and then you count for the 56 days, and that becomes your, whatever your FTE count was during that 56-day period, that becomes your numerator. If you choose a 24-week period, I think, unless something comes out saying otherwise, you're gonna have to go 24 weeks, and that's going to become your FTE count. And for some companies that may help as we're starting to kind of get out of this pandemic. For other companies, and I can give the audience an example, it's not a good situation because they're in the education business industry, and so specifically related to helping students come in, foreign students get acclimated to the U.S. And that business, that industry is being kind of semi shut down for a while. So while they were able to, and they're also at the end of their loan period. So while they were able to use the PPP funds to keep folks employed, during that 8-week period, those funds are now almost entirely exhausted. There is a small piece left, but they're almost entirely exhausted. If they have to, and at this point, there's not really any work. So for them to kind of keep those folks on for another 16 weeks without any work would be pretty devastating to the business. So they're going to have to do a couple things. They're going to have to do one, they're going to have to choose the 8-week period, and then they're going to have to wait to December 31st to go to utilize the safe harbor.
Right.
Which is frustrating.
That is frustrating. Hopefully they come out with some better guidance soon.
Yeah. Well, one thing I'll say is that the SBA has not been afraid to be somewhat contradictory to the legislation, right? So if we're talking about the original PPP Act under the CARES Act, they would issue these regulations. For example, the 75%, 25%. That doesn't exist in the CARES Act. The SBA had no problem coming out and saying, in consultation with the Treasury, we think you need to spend 75% on payroll. And there were other areas where they have, they've shown that tendency. So maybe with the Flexibility Act, maybe the next set of guidance will be, provide something that's brand new and not in the statute, but helpful to borrowers. If they do, that'll be a good thing. Okay, moving on. Okay. Now we're into the Flexibility Act. We've got these additional safe harbors. So you have the old safe harbors, which were related to those June 30th dates that we know are now moving to December 31st. And now you've got before this, the SBA had issued some safe harbors related to for-cause termination, right? So let's say you had 10 employees and during your denominator period, right? And then you had, during the covered period, you had to terminate someone for cause. So that would bring you to 9 during your covered period, right? So you're going to have loan forgiveness reduction. Well, before the Flexibility Act, they brought in some new concepts related to safe harbor, and one of them was a for-cause termination. So if you have a for-cause termination, that's kind of an exception to a reduction in FTE count. If you had an employee voluntarily resign, that was an exception to an FTE reduction, right? And so, just speaking from my business, Amber and my firm, we have a PPP loan, and we had someone that resigned. Well, until that new safe harbor came out, not part of the Flexibility Act, but pre-Flexibility Act, that would have been a FTE reduction on our account. And then they came out and said, well, now we're going to have those voluntary resignations, or someone voluntarily requested a reduction in hours. That doesn't count against you anymore. So that was good. Then we get to the Flexibility Act. Now we've got more safe harbor. So if anything, we're seeing this trend, I think, toward the SBA trying to make this more borrower friendly, because I think they had gotten a lot of backlash about, especially when Question 31 came out about liquidity and, and loans were going to be reviewed for, the good faith certifications. I think the SBA took a pretty big hit in terms of the kind of the response. And so it seems like they've started to ease up the burden. But so we've got these new safe harbors. One is an inability to rehire a former employee. There's something that was in there previously, required documented proof. This Flexibility Act safe harbor is a little bit more loose. Inability to hire similarly qualified employees. So if you run into that situation, that FTE, that proportionate FTE reduction won't go against you when you run that calculation. The third one there, I think, is one that could be maybe the most utilized by folks in industry, is that if you have an inability to return to pre-COVID, which they define as February 15th business activity, based on all the new rules and regulations that have been put in place by the Health and Human Services Department, CDC, and OSHA, then that proportionate reduction in FTE won't count against you. So obviously, restaurants, they clearly, fitness centers, yoga studios, I mean, those businesses are clearly going to be impacted. And one of the kind of debates we've had internally in our task force with Amber and a couple of our other folks from our firm, and situations I've been thinking through with clients and various businesses is that, okay, and what we really need is some guidance here, because that safe harbor as it stands, is that going to be applied kind of on a very direct basis? Meaning, for example, a restaurant, you probably could look through Governor Lamont's, action plan for various phases on what percentage of their restaurant can be opened up. And so it's a very clear open and shut case. That their business activity was reduced. But how about if you were indirectly impacted by that, right? So in my example, you've got a business they're not a school, but they are helping the education business through their for-profit business related to students. Clearly, they've been impacted. Now, is that if it may be indirect, and so would this apply? They haven't issued any guidance on that. I think at least right now, I think you have to look at your situation and try and put together the best. If you had a reduction in your full-time employees because of this inability to return to pre-COVID levels, it's just going to become a documentation exercise. Put together your facts and your facts and your support as to why you think you fit into it, and why you fit into the safe harbor. And then, you would claim it. And then if the bank asks questions, you would provide the evidence that you have. But I do think they'll come out with more guidance on that. I think they're going to have to. And it's either going to be some sort of a checklist saying if you're in these NAICS codes, then you have the ability to take this safe harbor, or they're going to say something along the lines of, facts and circumstances, document your case, and we'll review it. Okay, so that's the third bullet. They talk about proportional disregard of FTE. I think it's just going to be a prorated basis. They don't really give you a lot of information there in terms of those new especially the third safe harbor, the one we've been talking about here. Good faith and documentation requirements. So that's mentioned in the Flexibility Act that you make these safe harbors actions in good faith, and that you document it. Will tell us how much documentation is actually required and what documentation is actually required.
So, Bill, a good example in the nonprofit industry is going to be your arts. So your theaters that aren't able to open at full capacity, they could use this inability to return to pre-COVID as their safe harbor in their FTEs. Correct? So they may not get a reduction in their FTE count.
Yeah. So a little bit of feedback there. Yeah, so right, exactly. That's a great example, Amber. So that's a business that now, unfortunately, the Flexibility Act came in so late. Depending on when they got their loan, hopefully they got their loan on the tail end of the loan period. But if they did, business in that industry, if they got it toward the tail end, they can now extend that for they can kind of use all these various parameters within the Flexibility Act to make best advantage of the PPP loan. One, they can extend it for 24 weeks, right?
Correct.
Two, they may have to reduce employees because of the situation we're in, because of the sanitation requirements, because of the fact they may only be able to have 25% of the theater occupied at any given time. But if let's say their loan's $100,000, they can extend that for 24 weeks, pay the people that are absolutely essential to operate at their reduced level, which is going to be less than they probably were operating at pre-COVID. But they're going to fall under this safe harbor, I think. And then the fact pattern seems like they absolutely should, unless there's some sort of guidance that comes out that like I said, puts together some sort of NAICS code, and that's not sitting in the right code. But I can't imagine that's going to be the case. Otherwise, right, they're going to fit right under this. And so if they went from 10 employees to 4, that reduction of the 6 employees, that's not going to hurt that quotient, right? Because you just would disregard that piece, and you would either go to 4 over 4 or kind of add them back in, and you'd be 10 over 10.
Right. And just one last question on FTEs before we move forward. I'm getting a question. The PTE salary can be forgiven as well. I'm guessing, and if I'm not clarifying your question correctly, please respond again. PTE, I'm thinking you're saying part-time employees. Can you go over that quickly, Bill? I know that's not in our slides today, but that the equivalent is based off a 40-hour work week.
Yeah. So I keep using the term FTE. There we go. I used to like to use FTEE. One of our other partners called me out on that, but it's really full-time equivalent employee. So that includes full-time employees, part-time employees, employees working 80 hours, employees working 1 hour, right? So, but when you go through the calculation of a FTEE, anyone that works 40 hours or more a week are going to be counted as one full FTE. Anyone that works less than 40 hours is going to be included as a fractional part of an FTE. So you literally would go through and you would say, okay, here's my covered period. All right, John worked 20 hours this week, then he worked 40 hours, then he worked, and you have to do it over an average of their FTE status over the covered period, right? 20, then 40, then 30, then 10. You add up all those hours divided by the number of hours in the covered period, and that becomes that person may be a 0.9, they may be a 0.2, they may be a 0.1, they may be a 1, they may be a 1.0. They'll never be a 1.5. They can't ever get over a 1.0. But they'll become some sort of a fractional share of an FTE, fractional amount of an FTE, which again, is just a full-time equivalent. There is a simplified method, and we haven't gone through it here. It's that was also part of the original forgiveness application, which is going to get revised, whereby anyone that wasn't a full-time employee, meaning someone working 40 hours or more a week, becomes half of an FTE, full-time equivalent, right? So whether the person worked 39 hours or 2 hours in a week, if you wanted to use the simplified method, you put them all at 0.5. Other than, if you worked 40 hours, 45 hours, 50 hours, whatever, that you're a 1.0. But 39 and less, you can choose the simplified method. And there's different fact patterns that make sense for that, right? Depending on where your numerator was and where your denominator was. If you had, if in the January to February of this year timeframe, you had, your part-timers were all working like 35 hours a week, but now you only have them working, 10 to 15 hours a week, it would benefit you to choose the simplified method because you bring the higher numbers down and you bring in the denominator and you bring the lower numbers up in the numerator. So
Okay,
Hopefully that answered the question.
think so. So moving forward to the payroll requirement.
Yeah. Okay. So this was the shift. And again, this was completely, this whole thing was invented by the SBA, the whole 75%, 25%, that the Flexibility Act now actually makes it law, and it brings it to a 60%, 40% threshold, right? So your loan of $100,000, under the old guidance, you had to spend $75,000 on payroll. Otherwise, you're going to have some sort of a reduction in your loan amount. And there was a lot of, again, for folks that haven't really kind of been really close to this, that 75% threshold came out in the first subset of guidance that came out after the CARES Act. And it never really answered, like, well, what if you didn't spend 75%? What if you spent 74% on payroll? Does that mean that, you'd have 0%, you'd have none of your loan forgiven? Or does that mean you'd only have like a very small fractional share? What if you didn't have payroll? And I had clients that didn't. How they got through the gatekeeper of their bank, I don't know. They had all independent contractors. And so they applied under that theory. And so anyway, this whole 75%, 25% thing kind of got, like, it was discussed, it was debated. The application came out, and it really kind of went into how do you actually run that calculation. And the applicant, I think that finished application might have came out 2 or 3 weeks prior to the Flexibility Act. Well, anyway, fast forward to the Flexibility Act, which is the law that we are under now. And it's a pure 60-40 split. So you get your loan, $100,000, you got to spend $60,000 on payroll. If you don't, there'll be some sort of a fractional reduction to your loan forgiveness, right? So they haven't disclosed exactly how they'll do that. If it'll be just a straight up kind of, I spend $55,000 on payroll and I spend $45,000 on non-payroll items. Are they only gonna, is the calculation gonna be, they're not gonna forgive $5,000 because you're $5,000 over the 40% kind of cap on non-payroll, or whether they're going to do it like they did in the original application, which is to take your $55,000 you spent on payroll and divide it by 60%. I know it gets to an odd answer, and they're not too far off, but that's the way they've done it in the past. But the bottom line is you've now got this 60-40 split, which should give folks, again, a little bit more flexibility. Probably more so if they need to use, if they had a reduction in employees and they have a reduction in headcount, like you're the theater industry, but they still need to pay rent. This works out nicely because they can, start to mix and match all these various safe harbors and concepts, and you can extend this loan out a little bit more and maybe a little bit more specific to your set of facts. Like I said, I've got clients that spent the whole thing on payroll and didn't need any of the rent. Didn't have any PPP funds to spend on rent and utilities. But there may be companies that do need to spend more on rent and utilities, and this provision helps with that. Okay. Next concept, the flexibility added was the loan payoff deferral. So it basically pushes it back. It pushes it back until the date that the loan forgiveness is remitted to the lender. So for those of you that aren't familiar, when this program got instituted, the banks had to put up the funds to get out to the public for this purposes of loans. They're all guaranteed by the SBA, but the bank was the one that had to put the money out first. Once you apply for loan forgiveness, right, you'll submit your application to the bank. The bank has 60 days to review your application and give you a decision. And then the SBA has 90 days from that date to basically review the bank's recommendation and then remit, right? If the loan is forgiven, $100,000 loan, that's forgiven. The SBA is then going to pay that money over to the bank, right? So the bank's made whole. So the deferment period was originally was originally 6 months. This is getting this could get pushed out, and you try to do the math here a little bit, but your loan repayment date could get pushed out. Now, this all assumes that you have a loan that has to be repaid, right? I mean, you may have, hopefully everybody's going to get 100% of it forgiven, right? I think that's the kind of the hope for most folks. But if it's not, you could push this thing out like almost 20 months. If you look at if you elect the 24-week covered period, or if you have a loan after June 5th and you're in the 24-week period, then you've got 10 months to file your loan forgiveness application. And then you've got a 60-day review window and a 90-day review window. You might have to pay back any of these funds for up to 20 months.
Right. So we have had one person submit in to me, Bill, a brief copy from their application, and their loan forgiveness application expiration date is given within their loan of October 31st. I'm guessing that this will probably change with this amendment, and the fact that go ahead.
Check that. The original loan forgiveness application had October 31st.
Mm-hmm.
So I don't know if the one that you got sent is kind of the original version.
Probably the original version. So I'm guessing that will be changing.
It's going to have to, because the safe harbor is December 31st. So,
right.
And they give you 10 months, after your 10 months after your covered period, right? So you choose the covered period of 24 weeks. That puts you out. What is that going to add? Another 4 months, right? So we're looking at July, August, September. You're looking at almost the end of October anyway.
Right.
Plus you got another 10 months off of that.
Right.
So
we do have 2 more quick questions on FTEs, but I know we're starting to run low on time, and I want to make sure that we get to how to record this within the financial statements of the nonprofits. But one question to clarify: if a person is working overtime, so more than 40 hours on a consistent basis, their FTE is still 1. You can't make them 2 or 1.5.
Correct.
Okay, always 1. And
now, just one comment on that, Amber. So it's supposed to be your average, your average FTE status over the various periods that we talked about. So you could have an employee that works like 30 hours, right, 1 week, and then works 50 hours the next week, right? So you would just they would still be 1. They wouldn't be a 0.75 in 1 week and then a 1 point, even though they work 50, a 1.0 in week 2. And so that when you take those 2 and average those, it becomes less than 1.0. You would take all those hours and add them up and then divide by the number of weeks. Right.
Okay. Thank you for that. Yes. And one other question I'm getting from a few other people is regarding per diem employees. Are they considered part-time? And I would say if you're paying them via W-2 employee, then per diem employees count. But some of the nonprofits, Bill, use temp agencies. So they hire they hire through the temp agency, but they're not actually the nonprofit's employee, but they pay the temp agency funding. Does that count for payroll?
Yeah, I mean, we've had that question a number of times. Right now, I would say no. I don't think the Flexibility Act didn't seem to open that up. This whole thing has been it's been a little bit of a tornado in that it's gone around and round and round. If you had asked me this question on March 28th, I would have said yes, because I think the CARES Act allows you to pay independent contractors. Then the first set of guidance kind of doubled down on that and said, yeah, I mean, it certainly had some reference to independent contractors, said you couldn't include them as employees, but certainly had references to including them in your spend. And then like the third or fourth round of guidance basically said, no, you cannot use PPP funds to pay independent contractors. And nothing's really shifted since then, including the Flexibility Act. So I think as of right now, I would have to say, no, you can't use the funds to pay temp agencies who are then going to those folks actually employ the individuals who then bring those individuals to help out with your business. I don't think you can.
Okay, thank you.
think I only have one more thing here. So then the last piece is the employer tax deferral. So if you've elected to defer payroll taxes, you can now. There was some debate as to, well, could you even do that if you were getting a PPP loan? The statute said that if a loan was forgiven, then you couldn't defer taxes. Then the IRS came out and basically provided some guidance saying that you can defer up until the point of the forgiveness decision. And now the Flexibility Act has basically just said you can defer out to December 31st. Excuse me. So that's kind of where that stands right now. So if you are deferring your payroll taxes, just know that you can do that through December 31st of 2020. 50% of whatever you deferred will be due December 31st of 2021, and the other 50% of what you deferred will be due December 31st of 2022. So not a credit. It's not. Those funds will eventually be due, but if you need to save some cash in the interim, I like this option, just knowing that they will be paid back, within the next 2 years.
Right. And it's important to point out, because I've heard in the past from nonprofits, well, we don't have a tax that we pay on through our tax return through the 990. It's important to point out that these credits can be taken, or deferment can happen through your payroll tax.
Right.
So it's not through your regular tax return. This is through your payroll tax. So reach out to your payroll provider regarding this.
Yeah, it's the FICA piece, the employer piece of the payroll tax, right? So you're employing Johnny, and you're paying Johnny, and Johnny's paying, he's paying his piece of the tax, and you're paying your piece of the tax. And so your piece, so the business's piece of the tax is the piece that you can defer.
Right.
So that let me see. I think I got one last slide, but it's really just kind of an overstay. I think we've touched on all this. It's really kind of what we're waiting for. Like I said, I wish we had some more to report to the group here, in terms of just some guidance that had to give a little more color on some of these things, but we don't, right? They've issued a couple pieces of guidance, but it's just, one guidance is completely related to convict history and felony history, and whether you could apply for a PPP loan with a felony conviction. And, I'm helpful to someone, but I think it's not helpful to the masses. The questions that I've laid out here are really where I think they need to go. And so hopefully we'll get something on that.
Thank you. Okay. So what I want to go into next is how you're going to be reporting this internally, how the numbers are going to be displayed on your financial statements. As many of you are June 30 year ends, you have 15 days till the end. And it's really unsure, right, at this point, how much is going to be forgiven and how much is not. There's been guidance that has been released through AICPA that this loan, right, can be treated either as debt or it can be treated as a conditional grant. Okay, so what I did is, if you took my webinar a month or so ago, this slide will look familiar. I borrowed it from the FASB's update. So if we're following that this is a conditional grant, this is revenue recognition, right? So we're up to the point of our conditions presented, and have you met those conditions? So really you have to think about what are the barriers, right? So the new conditional grants have new guidance, 2018-08, came out, and it's applicable for all nonprofits ending in June 30, 2020, or those that ended December 31st, 2019. You're following this new grant guidance, and they've made conditional mean a little bit more than it did historically. You have to have the right to return and a barrier. Okay. And barriers aren't judged on the probability of you're going to meet them. So if you think you're going to meet all the forgiveness guidelines, you still have that barrier of actually meeting the forgiveness guidelines. I just want to point out, I included in the slides the definition of a barrier because I think it's a new concept to many people. And it's you, the nonprofit, need to evaluate the facts and circumstances of the agreement, right? So this is your allowability of what you can spend the funding on, right? Your payroll, health benefits, etc., rent, utilities, and the FTEs, right? So those are your two starting barriers: the expenditures and keeping and maintaining a certain level of FTEs. So barriers definitely exist. So it is a conditional gift. So the question comes in, when are you meeting these conditions? And when can I recognize it as income? Okay. So for all of you, cash has come in. So you're debiting cash and you're going to credit either debt or you're going to credit a refundable advance. Similar as if you received a grant payment in advance of spending it. You would put it as a liability, right? So then the question comes in, when have you met the barriers? And what are the barriers? The barriers could be maintaining FTEs. The barrier could be submitting the loan application itself. It could be the expenditures itself, making sure you can expend all the dollars. Those barriers are going to be different for each of you. There's no blanket answer on what the barriers are. It's more of a determination internally. So if you've decided I'm going to use the PPP, I've maintained my employees, and I'm going to do that throughout the duration of my 8 weeks, my 24 weeks, or I've ramped up enough to meet those FTE requirements, then I would say that's not a barrier. It's your determination because you have the ability to control hiring, layoffs, and furloughs. So if you determine you're not going to, so you've reached your 8-week period and you have the enough FTEs, if you are determining that I'm going to keep those FTE count through the 24 weeks, then that's really not a barrier anymore. And at that point, I would say you could recognize the income as you've expended the money. Now, if you're an organization that your FTEs have kind of wavered throughout this, I would be a little bit more conscientious about recording the income and recording the forgivable piece. What I would suggest is you do your calculations of what your forgivableness is going to be. Calculate it at the 8 weeks, calculate your expected 24 weeks, and then work with your auditor to determine how much should I record as a forgiveness now versus how much should I wait. It's really determining what are the barriers and when have you met the barriers. I had a deep discussion this morning earlier with Frank. Bill mentioned he was on the task force earlier about he's not a nonprofit, but he understands PPP throughout this in detail. So is the barrier really meeting the FTEs, or is that just operational funding and you're choosing operationally to keep your employees at a certain level, right? So that's where it's going to come in, that each organization is going to treat this a little bit differently. And there's no blanket answer. I know there's multiple questions that came through the chat room of, can I record this income now? Or do I need to wait? And I think the answer is it's going to depend. You have to walk through your factors, walk through what your calculated forgiveness is going to be, and then where you kind of land is going to be your determination of what's recorded now versus what's recorded later. If you have to wait for that safe harbor of December 31st, it's my current opinion, and my opinion could change tomorrow with new guidance released, is that if you have to wait for that safe harbor to occur December 31st, then your barrier is not met until December 31st, and you wouldn't record that conditional grant income until that barrier is met. But again, this guidance is changing rapidly, and we don't know. The other piece that's changing.
Hey, Amber?
Yep.
I was just going to say, I don't know if you want to comment on the discussion you and I had prior to this webinar, which was, and I don't think I mentioned it when I was going through my piece, but right now you've got this 8 week, or you've got the 24 week or the 8 week election, but there's really no way to elect it right now, other than potentially through the forgiveness application that hasn't even been published yet, right? The revised forgiveness application that's going to be published. So if you had a situation where you had a nonprofit that said, okay, you know what, I listened to Bill and Amber, and I've spent 85% of my loan proceeds, and I know I've got a pretty solid FTE count for that 8-week period, but I'm gonna kind of wait and see. And I think this is the way you and I discussed it. I can right now, at least, because there's no requirement that you make the election like on day 56. There's no requirement that you tell your bank on day 56. There's no requirement that you tell the SBA on day 56. I'm electing the 8-week. I'm electing the 24-week. You can kind of play it out here a little bit, right? And you can say, take a little bit of a wait and see approach. Let's see where my FTE goes. Let's see what my 24-week, what happens in the next couple of weeks. Maybe the other 15%, maybe I can spend it. But if you did that, right, and let's say it was just kind of, again, make the numbers easy. You spent $100,000, and so now you had a $100,000 loan, but you spent $85,000, and your FTE counts pretty solid. But you want to take this wait and see approach on the 24 weeks. I think we said we still think you might be able to recognize the 85,000 as income, because you can always backtrack and elect that 8 weeks if you needed to, right? So let's say you said, I'm going to hold off. I'm going to see where the 24 weeks goes. And then in week 12, you have to shut down for whatever reason. We get right back. We're right back into COVID and for whatever other or any other business reason. You have to, and so now your FTE count goes super low. But you can, I think at that point, you can still make your election to go to the 8 weeks when you fill out your loan forgiveness application. And so that you can almost lock in that 85,000 of income to the point that you're talking about more so than what I was talking about, right? That would be potentially, they would eliminate that barrier, I guess.
Yes. Particularly if your 8 weeks is on or near that June 30th date, like if you're, I would say 80 to 90% through it, or you're done with your 8-week period on June 30th, I would definitely go through that calculation process and calculate what my forgiveness would be. And then you could definitely record that piece as income. But then still keep it going for that 24-week period, so 16 more weeks. You just wouldn't be able to release what you're estimating that 16 weeks to be. I would say I would keep it at what's been passed so far and recognize that piece that has already been spent.
Right, and that would all assume that you, for an 8-week period, you had a good FTE number. Yes,
so that you're not relying on that safe harbor, and that your FTEs don't even have to be the 1-to-1, right? It could limit you to the 80% or the 70% and still just record that portion of it.
Yep, exactly. Yep.
Another hot topic, and there's still lots of discussions going on through your various industry groups, like your National Nonprofit Council group, your alliances. They're still talking about and still trying to negotiate, I guess, or lobby with your state and federal funders, right? So if I have a state grant for my payroll, there are some state funders, particularly I know DDS and Federal Department of Justice have said you cannot use PPP dollars for payroll and use those same payroll dollars as your grant expenditure, right? I believe DEMIS has come out and said the same thing as well. I think that they're just not being as pointed in their conversations. So the question is it better to take the PPP funding, put the payroll dollars towards that, and it's forgiven, and then you don't receive that, then you have to return your state or federal dollars for that portion if you can't spend it elsewhere, right? Or is it better to don't put that towards your PPP forgiveness and then pay interest on your debt so it's not forgiven? One, I'm not sure the guidance is clear enough to say that you have the option of paying payroll and not making your PPP forgivable. I'm not sure that option actually exists yet, but it's possible. Some things I've discussed with clients is reach out to your state funder, right? Because the big question a lot have asked is, well, if I use PPP funding and it's forgiven and I have to give my state dollars back, are they going to reduce my contract next year because I didn't use it? which I know is a historical concern. You will always make sure you spend the money because you don't want it to be reduced next year. If you have those conversations up front, I mean, COVID-19 is certainly not a secret. PPP funding is certainly not a secret. So this is conversations that I think that you could have with your funders to see, one, can they extend the grant? So if it's a grant that ends 6/30, are they willing to extend it another 6 months without changing your future grant period? Can they be flexible in other ways other than it's this or that? So I would just encourage you to have those discussions so you're not making those decisions without those considerations in mind. I know that there are some out there that just completely disagree with this factor and that it shouldn't be the thing. But in most grants, if you read your grants, even if you're funded by multiple state grants, they'll say in their grant, the expenditure can only be used once and not by multiple funders. Multiple funders can't fund the same dollar. Okay, so I know that there's been a lot of questions that have come through the chat on that, and just in general from my clients, I've been receiving them. So in general, you can't use the same dollar twice, but I highly recommend you reach out to your funders, to the grantors, to see if you can get an extension, to use the dollars, to see if you can use the dollars in other areas. A lot of our programs are underfunded, so can they be used in revamping your program versus the payroll dollars? Maybe they can be used in different functions that the PPP isn't covering. Okay, so that's really all I wanted to say on that matter. I just want to scan the questions to make sure we've covered everything.
Hey, Amber, just one comment on, I don't know how relevant it was to the point you were making, but you actually can spend the PPP funds and not have them forgiven. And the guidance that was out there, they basically said if you don't file your forgiveness application within 10 months, it just becomes a loan.
It just becomes a loan.
Yep.
Okay, so that is definitely.
I don't know why anyone would. Yeah, yeah, exactly.
Well, I guess you would consider doing that, Bill, because the percentage, right, is I should know this, but I don't remember. It's like 2%, correct?
The interest rate?
Yep.
1%. Yeah.
1%. So that is it. Worth paying 1% interest rate versus giving back dollars back to the state and risking that your future state dollars be declined because you return the money back. That would be a reason to keep it. But again, I wouldn't want to make that decision in the blind. I wouldn't make assumptions here. Talk to your state and funding departments because they know what's going on, and they know that maybe you can put those grants towards your COVID expenses, towards your PPE expenses that are heightened. That PPP isn't covered. Okay. One question that just came in: if you get the loan in May, can you hold off recognizing expenses against it until the new fiscal year? Unfortunately, with GAAP, once you expended the dollars and the expenses related to that period, you would have to, it's accrual accounting. So you wouldn't be able to hold back expenses unless you're saying you're purchasing supplies and supplies are received in the next fiscal year, then you wouldn't record those expenses. But if you're talking about payroll, the accrual accounting has to maintain integrity.
In that question, I don't know if I don't have it right in front of me, but were they asking whether they could you avoid using the PPP funds to pay payroll during, like if you received your loan in May, could you not use the PPP funds for the June timeframe?
And then
and it would only make sense if you were doing the 24 weeks, obviously, because you just don't have enough time within the 8-week window.
Okay. So I got my loan May 1st. So I have 8 weeks of the fiscal year left. I could use payroll dollars towards my grant, but not towards PPP. And then the next 16 weeks, apply it to PPP and not the grant. Yeah, I guess you could do that. Just scanning through. I think I've answered or we have answered all the questions. Actually, there was one question I skipped towards the beginning about if an employee goes on disability late in October or early December, is that going to affect the loan forgiveness or affect the FTE calculation?
Well, I mean, we're going out into October, right? So if they chose a 24 period, I think October would fall out of it in almost every instance, right? Unless you end up getting a loan like at the end of June. So it wouldn't, unless you needed to get into the safe harbor, in which case you had to have people in place on December 31st. And the way that they do that is it's like, well, at least the way they did it for the June 30th was your full-time equivalents in the payroll cycle that included June 30th, right? Now that June 30th doesn't exist. So unless they change it, would be the payroll cycle that includes December 31st. So if those people were out on short-term disability and you needed to use the safe harbor, that number in 31st payroll, your full-time equivalents has to equal your February 15th, 2019 FTE count. Otherwise, you don't qualify for the safe harbor. Now, if they're on short-term disability, trying to think if there's any other safe harbor exceptions that they would potentially meet. Inability to rehire the employee, I think that probably fits in there. I don't know that I've seen it specifically mentioned in the guidance, but you might fit into one of those new safe harbor exceptions. But that'd be the only place, right? Because I think those people shouldn't get into your numerator denominator calculation. That should already be set and defined. You just may need them for the safe harbor that goes on December 31st. And so if they're not in that number, we're like layering on safe harbors here. Can you use a different safe harbor to get them into that? I don't know the answer to that question. I think there's probably a potential case for it.
Okay. Thank you, Bill. And maybe just one last question. According to PPP, I thought employer taxes were not forgiven, but we can defer them. Is this a correct understanding?
Employer. Well, yeah, depending on when you applied, you may have gotten your employer taxes into your base, meaning the amount that you applied by 2.5 to get to your loan amount. But they're not forgiven. The SBA then kind of closed that down, saying that you shouldn't be putting that into your application, and they're not forgiven. So, they're not forgiven. The law allows you to defer them.
Thank you. Okay, well, thank you everyone for joining this webinar today. Tango, thank you for giving us the platform to present to everyone. Bill and I are available for questions if you want to reach out to us. I'm happy to help out, and hope you enjoy the rest of your day.
Yeah, thanks, Bill and Amber. And as Raylan mentioned, our partners are here for you. So as a member of Tango, take advantage of their exclusive offerings, which you can view on our website. We have another webinar this Thursday focusing on managing nonprofit endowments and investment portfolios. So feel free to sign up if you'd like. And lastly, Tango's mission is to help nonprofits thrive. So if you're not currently a member of Tango, visit our website, sign up today. And thanks again for joining, and everybody stay safe. Thanks, Amber. Thanks, Bill.
Thanks, Rob.